Life insurance explained in 10 minutes. Did you know that 75 million Americans have zero life insurance coverage, and 27 million more are seriously underinsured? If something happened to you tomorrow, could your family maintain their lifestyle, pay the mortgage, send the kids to college? Over the next 10 minutes, I will break down everything you need to know about life insurance in America in simple terms. No confusing jargon, no sales pitch, just the facts you need to make an informed decision. By the end of this video, you'll understand what life insurance actually is and how it works, the main types of policies available, how much coverage you really need, and the tax benefits that could save your family thousands. Let's dive in. What is life insurance? At its core, life insurance is a financial contract between you and an insurance company. Here's how it works. The simple exchange. You pay regular premiums, monthly or annually. The insurance company promises to pay a death benefit to your chosen beneficiaries when you pass away. Your beneficiaries receive this money income tax-free. Key players. 1. The policyholder. That's you. You own the policy and pay the premiums. 2. The insured person, usually also you, the person whose life is insured. 3. The beneficiary, the person or people who receive the money when you die. This could be your spouse, children, a trust, or even a charity. The big benefit. Here's what most people don't realize. In 2023, U.S. insurers paid out $89.1 billion in death benefits. And in most cases, beneficiaries receive that money completely tax-free. That's federal law under Internal Revenue Code Section 101. Think of it as a financial safety net. If you're the breadwinner bringing home $75,000 a year and you suddenly pass away, life insurance replaces that income so your family doesn't lose their home, can't pay for college, or struggle to make ends meet. The two main categories. All life insurance falls into two main categories, term and permanent. Let me break down both. Term life insurance. Think of this like renting coverage for a specific period, typically 10, 20, or 30 years. Key features. Covers you for a set period only. No cash value accumulation. Significantly cheaper than permanent insurance. Death benefit only if you die during the term. Best for 90% of people. Real numbers. A healthy 30-year-old male can get $500,000 in 20-year term coverage for approximately $25 to $35 per month. That's less than your Netflix and Spotify combined. Permanent life insurance. This is like owning coverage. It lasts your entire lifetime as long as you pay premiums. Key features. Coverage for your entire life, includes a cash value component, much more expensive than term. Death benefit is guaranteed if premiums are paid, and can borrow against cash value. Real numbers. That same 30-year-old male, whole life insurance for $500,000 could cost $400 to $600 per month. That's 12 to 20 times more expensive than term. Which should you choose? Here's the rule of thumb. If you need coverage for a temporary need, like until your mortgage is paid off or your kids finish college, choose term. If you need lifelong coverage for estate planning or leaving an inheritance, consider permanent.
Types of permanent insurance. If you're considering permanent insurance, you have three main options. Let's break them down. Number 1, whole life insurance, the most traditional permanent policy and the most straightforward. Features. Fixed premiums that never change. Guaranteed death benefit. Cash value grows at a fixed guaranteed rate. Most predictable option. In 2024, whole life represented 36% of the U.S. life insurance market. Who it's for? People who want stability, guaranteed returns, and are willing to pay higher premiums for predictability. Number 2, universal life insurance. Permanent coverage with more flexibility. Features. Adjustable premiums. You can increase, decrease, or even skip payments if you have enough cash value. Death benefit can be adjusted. Cash value grows based on current market rates with a minimum guarantee. More control over your policy. represents 7% of the market. Who it's for? People who want flexibility and are comfortable with some market exposure while maintaining minimum guarantees. Number 3, indexed universal life. The growth-focused option tied to market indexes. Features: cash value linked to market indexes like the S&P 500 or Nasdaq. Built-in floor, typically 0%, protects against losses. Ceiling, cap limits maximum gains. Most popular variant, 26% of 2024 market share. Higher growth potential than traditional universal life. Who it's for? People seeking growth potential with downside protection who understand market-linked products. Number 4, variable universal life. For those who want investment control. Features: you choose how cash value is invested: stocks, bonds, mutual funds. Highest growth potential, highest risk, can lose value. Most complex option. Who it's for? Sophisticated investors comfortable managing investment risk. How much coverage do you need? This is the million-dollar question, literally. Let me give you 4 proven methods to calculate your needs. Method 1, the quick rule, 10 to 20x income. Multiply your annual income by 10 to 20 times. Example, you earn $50,000 per year. 10x equals $500,000 coverage. 20x equals $1 million coverage. Pros: super simple, fast estimate. Cons: doesn't account for debts, savings, or specific needs. Method 2, DIME formula, most popular. This is what financial planners recommend. DIME stands for D, debt, all debt except mortgage, credit cards, car loans, student loans. I, income, annual income times years you want to replace it, typically 10 to 15 years. M, mortgage, outstanding balance. E, education, estimated college costs for kids. Real example: debt, $25,000. Income replacement, $75,000 times 10 years equals $750,000. Mortgage, $200,000. Education, $50,000 per child times 2 equals $100,000. Total needed, $1,075,000. Method 3, income replacement. Calculate how many years of income your family needs. If you're 35 with 30 working years left and earn $60,000 per year, $60,000 times 30 years equals $1,800,000. Subtract existing savings and investments to get your coverage need. Method 4, human life value. Most comprehensive considers your total earning potential minus your own living expenses. Formula: annual income minus your living expenses times years until retirement. Example, income $80,000, your expenses $20,000, years to retirement 25. $80,000 minus $20,000 times 25 equals $1,500,000. Don't forget, according to the National Funeral Directors Association, the average funeral costs $8,500 in 2025. The College Board estimates 4-year private college at $43,350 per year in tuition alone, $173,400 total. Add $58,600 per year if including room and board. Bottom line, most Americans need 10 to 12 times their annual income and coverage. Use a calculator or speak with a financial advisor for your specific situation. Critical tax information. Here's the best news about life insurance. The tax benefits are incredible, but you need to know the rules. The good news: tax-free death benefits. According to IRS Publication 525 and Internal Revenue Code Section 101, life insurance death benefits are generally not taxable income for beneficiaries. What this means? Your spouse receives $500,000, zero federal income tax. Your children get $1 million, tax-free. This is law, not a loophole. But watch out, 3 situations where taxes apply. 1. Interest earned on the death benefit. If your beneficiary doesn't take the lump sum immediately and the money sits earning interest, that interest is taxable. Example, death benefit $100,000, tax-free. Interest earned over 2 years, $10,000, taxable. 2. Estate tax threshold. If your total estate exceeds $13.99 million in 2025, the federal estate tax exemption, life insurance proceeds may be included in your taxable estate. Critical, this limit is set to drop significantly after 2026 unless Congress acts. State estate taxes may apply at lower thresholds. Check your state laws. 3. The Goodman Triangle. Three-party problem. This happens when 3 different people are involved. Person A owns the policy, person B is insured, and person C is the beneficiary. Example, dad buys a policy on mom's life, names their son as the beneficiary. The IRS sees this as a gift from dad to son, potentially triggering gift taxes if it exceeds $19,000 in 2025 annual exclusion or $13.99 million lifetime exemption. Solution? Keep it simple. Only 2 parties. You own the policy on your own life. Advanced strategy. Irrevocable Life Insurance Trust, or ILIT. For high net worth individuals, transferring policy ownership to an ILIT removes it from your taxable estate. But this is irrevocable. Once done, you can't undo it. Consult an estate planning attorney. Cash value withdrawals. With permanent policies, you can generally withdraw up to what you've paid in premiums, tax-free. Anything above that, taxable as ordinary income.
Who needs life insurance? Let's get specific about who needs coverage and why. You definitely need life insurance if 1. You have dependents, young children who rely on your income, a spouse who couldn't maintain lifestyle without you, elderly parents you support financially, a child with special needs requiring lifelong care. 2. You have significant debt, mortgage, $250,000 average U.S. home loan, student loans, average graduate carries $30,000 plus, business loans, don't saddle your family with your business debt, car loans, and credit cards. 3. You're a stay-at-home parent. Critical point. Even if you don't earn income, your services have value. According to Salary.com, a stay-at-home parent's work is worth $184,820 per year, including childcare, housekeeping, meal preparation, and transportation. Your family would need to pay for these services if you weren't there. 4. You own a business. Protect business continuity. Buy-sell agreements funded by insurance. Key person insurance. Debt obligations. 5. You want to leave a legacy. College funds for grandchildren. Charitable giving. Inheritance for heirs. You might not need life insurance if you're single with no dependents. You have sufficient assets to self-insure. Your children are grown and financially independent. You're retired with no debt and adequate savings. Optimal timing. The best time to buy? When you're young and healthy. Premiums are locked in based on your age and health at application. A 25-year-old pays dramatically less than a 45-year-old for the same coverage. Common mistakes to avoid. Before we wrap up, here are 5 critical mistakes people make. Mistake number 1, not updating beneficiaries. Life changes. Divorce, remarriage, births, deaths. Update beneficiaries after major life events or your ex-spouse might get the money. Mistake number 2, naming your estate as beneficiary. This triggers probate, which is expensive and slow, and may make proceeds subject to estate taxes. Always name individual people or trusts. Mistake number 3, buying only through your employer. Group life insurance is great, but typically limited to 1 to 2x your salary. If you lose your job, you lose coverage. Get your own policy that follows you. Mistake number 4, underestimating future needs. Remember inflation. A $250,000 policy might seem adequate now, but in 20 years, consider higher coverage or add riders. Mistake number 5, no contingent beneficiary. If your primary beneficiary dies before you and you haven't named a backup, the money goes to your estate. Mistake number 6, letting policies lapse. Missing payments can cause your policy to lapse. Set up automatic payments and keep contact info current. Call to action and wrap up. Let's recap what you've learned today. Key takeaways. Life insurance provides tax-free money to your beneficiaries when you die. Term insurance is best for 90% of people. Affordable temporary coverage. Permanent insurance offers lifetime coverage with cash value, but costs 10 to 20 times more. You need 10 to 12 times your annual income in most cases. Death benefits are tax-free, but watch out for estate taxes and interest income. Update beneficiaries regularly and avoid naming your estate. Next steps. 1. Calculate your needs. Use the DIME formula we discussed. 2. Get quotes. Shop at least 3 to 5 companies. Prices vary significantly. 3. Apply while healthy. Medical conditions increase premiums or cause denial. 4. Review annually. Life changes, your coverage should too. Remember, 50 million middle-income Americans have no life insurance. Don't let your family become a statistic. The peace of mind is worth more than the cost. Life insurance isn't about you, it's about the people you love. It's the ultimate act of responsibility and care. For often less than your daily coffee, you can ensure your family's financial security. If you found this video helpful, please give it a thumbs up and subscribe for more insurance education without the sales pitch. Drop any questions in the comments. I read and respond to everyone. Thanks for watching, and remember, protect what matters most.